Okay, everybody hear me now? Sorry about that. I don't quite know why that was happening. Welcome to the Avondale webinar, How Employee Ownership Can Drive Trade Sales. Apologies, I've been talking for 1 minute to a screen, so we'll start all over again. Employee ownership has been a growing trend in the last 5-6 years since the Lib Dem and Conservative government encouraged it with a 0% tax regime. There are now some 370 companies operating across employee ownership in the UK, and it's growing at a fast pace, something like 100 companies a year joining. Now, for those of you who know Avondale, you'll be aware that we help people buy and sell companies. We also do strategy and a bit of corporate finance, but increasingly we're also doing employee ownership transactions. And we need to examine why, and today is really about the finance and funding side of it. One of our previous webinars was very much around how you run the trust structure and also the benefits of the employees, whereas today is much more around financing, funding, and how you can gain value through doing employee ownership. Now, we will be sharing the slides and video online. Please look at the front page of our website and we'll be putting it online there. And if you've got questions, please fire them as you go. It'll be helpful. So why and how employee ownership can beat trade sales. Now, I've been helping people buy and sell companies for something like 30 years. Trade sales, of course, have been the sweet spot. If you can get a motivated trade buyer with synergy, economies of scale, shareholder value, and positive disruption, you will get a very high multiple on exit. And we manage auction processes to achieve that. But not every company can get to that position. And typically, it's businesses where the recurring revenue is either too low, so there's a bit of uncertainty on cash flow. And certainly with COVID, that's an increased challenge, but often also where the business is too dependent on the owner-manager. Now, we think employee ownership needs to be given more of a spotlight, and the reason is this slide: 0% capital gains tax. Many of you will have noticed that in March, the capital gains tax raised from 10% to 20% above $1 million in terms of the sale of shares. So entrepreneurs' relief used to be up to 10 million, now it's capped at $1 million. Those of you who read the press, you'll also be noting that capital gains tax is due for a further review and looking at placing it more in line with income tax as a possibility. We think it's just as likely that they'll put capital gains tax on private residences and gains on a taper basis, depending on how long you've owned them. But it is equally possible that trade sales won't be taxed at 20%. They will move more in line on income tax and move to 40%. So there's a real sweet spot at the moment to examine employee ownership before any future tax changes. And the key behind the funding arena is that a sale can be structured with a 0% tax on that capital gain. So it is possible to start gaining on that really attractive trade deal with the benefit of a 0% tax. And that's a key driver. Yes, all the other drivers exist. We want to create a legacy. We want more productive businesses, and we want to reward the employees. But you've worked hard for your business, you've built it, you've gained a position where it's got value. We want to extract that value. And at the moment, there is a window of opportunity at 0% tax. So we can't ignore that. And again, hence why we think there's a real spotlight on employee ownership trusts. So I think the other point about employee ownership trusts, and so we want to examine the structure and really examine the funding side of it. But the key is that they don't have to be an immediate exit for the shareholders. Employee ownership, you can stay an owner-director. So businesses where you haven't necessarily managed to create the succession that you'd hoped, haven't managed to build the management team you'd hoped, the business is perhaps still a little too dependent on you, you've got time to build that even after you've created an employee ownership structure. many of our clients who are doing employee ownership don't actually discuss it initially with their team until they've got the funding and the finance position clear in their heads before deciding whether they're actually going to do it. They then only bring the management team in later. Some of them are also then building that management team over 3-5 years as they see where the deficiencies are within a team-driven environment. So as employee ownership, although so long as you sell more than 51%, you get that 0% tax. We would encourage 100% to lock the 0% tax in, but you can stay an employee typically for many of our owners on a reduced salary, because the benefit of that is you're then leaving cash flow to pay for any leverage debt or vendor loan notes to fund the buyout to gain your value of the sale. So reducing salaries, but also from a tax point of view to reflect ideally reduced lower hours and responsibility as you built the team behind you. So 2 big compelling reasons why EOT should be spotlighted: 0% tax, flexible exit strategy over a longer duration. And we think that's very positive. In some respects, I mentioned earlier that there's something like 100 companies a year now moving to employee ownership. And in some respects, I think the biggest driver or sort of barrier to being a driver is the ability to get cash out on day one. Now, we're structuring most of our clients' employee ownership trusts using 3 funding arenas. One, reserves and any surplus cash that may be in the business. Now, interestingly, at the moment, quite a few of our clients took the civil loans. They haven't used it. They've used the furlough scheme. Business has been still reasonably strong. So they've actually built up cash reserves over this duration. So if we're right that CGT may be under the spotlight, because we don't know how long this 0% is going to stay, then there's a real window of opportunity, perhaps before the next April budget, to use those reserves and get some initial cash out. And the other way that we're doing transactions with cash out is third-party debt. So you've got asset-based lending, invoice factoring, and cash flow loans. And of course, there's all the due diligence that you need to go through to get that funding. And then the third way is the vendor loan, and that's structuring debt over a period, typically between 3 and 7 years, using the business's cash flow to pay the vendors. Now, I said it's surprising there's only 100 companies a year doing this, and we think that sits around 1 and 2. People are looking at this exercise versus trade sales and going, well, actually, I can get more money up front out of a trade sale. I want that money. I need to go and spend it because then I've realized the value of my business. But post-COVID, can I just sort of make a point? I think that's changed. I think that, people wanted the initial cash out because they wanted to go and buy a holiday home or a boat. They wanted to invest the money in property or other equities in order to create a yield. But actually, the post-COVID world doesn't make it so easy for the holiday home. And in terms of other yields, a 5% yield on a vendor loan is highly attractive. Of course, if you get your share buying right, I wish I bought Apple in March, double the value, crazy. Then you will get a yield. But actually, a 5% guaranteed yield on a vendor loan note is pretty good. So we think, and we're seeing this trend, that people will look at structuring employee ownership where the initial cash out maybe less than, say, 20% out, and then the rest, 80% over the duration, to lock that 0% tax in, which is obviously highly attractive. Guys, by the way, if you've got questions, please fire them at the Q&A. Otherwise, I've had 2 coffees this morning, so I'm going to rabbit at you and keep going. Also, when Sue joins in, again, please make sure you get your questions lined up. So she'll be joining us in a minute to share some of her experiences around employee ownership trust. So, funding, 3 key ways: distributable reserves, third-party debt, vendor loan. Vendor loan just got more attractive. 5% yield. But the other reason vendor loan is attractive, and if you think about it, third-party debt, banks are tough, they foreclose. Whereas a vendor loan is a promise to pay rather than an absolute commitment. So as you're still involved in the business, you can control that payment, and there are certain covenants that can be put in place to control that vendor loan. However, if the business, and COVID, we're going to see a lot more volatility of cash flow. If the business has cash flow issues, then the promise to pay actually gets kicked out. So you might structure your vendor loan over 5 years, having taken a bit of salary sacrifice, given a bit of headroom in there for volatility, but cash flow is still slow, the vendor loan can kick out. It can even, to a certain extent, be waived at your choice. So, the key is to structure with HMRC a strong valuation based on comparative values, but also cash flow at a higher headline price, aim at it. But if you don't get there, you can extend the period and or waiver the sums if necessary. So very, very flexible, and they don't sit on a balance sheet in the same way as third-party debt. So again, from a trading creditor position, quite flexible. We've had a question in from one of the delegates around the point on the slide here, no personal guarantee. So I'll take that whilst we're on the slide. And that is what does that mean? Well, any third-party debt, typically the sellers will have to sit behind that third-party debt, because you can't ask the management to do it because they're just employees. So it will be the sellers that personally guarantee any third-party debt. So it's really a bit strange, isn't it? If you think about employee ownership trust, you're both seller and buyer in a way. So genuinely sitting on both sides of the fence and balancing what the business can afford to pay out of that cash flow, whether it's third-party debt or vendor loan. We've had a number where we've actually succeeded in raising. We had one where we raised a £2.5 million facility, but the sellers then decided they'd rather do vendor loan. They didn't need the money on day one, and they thought it's a good yield. But also they felt the soft aspect of vendor loan and collectability more suited the culture and the benefits of the employees. It did not want to put them through the stress of a leveraged buyout, if you like. So we think employee ownership trust also does pick up on where historically management buyouts have been de rigueur, but where you've got management that don't necessarily also want to stand behind personal guarantees and take on huge amounts of debt in highly volatile markets, which COVID has created. So from a tax point of view, we've also had the question: is capital gains tax for EOT under review? Look, the whole regime is with the Office of Tax Simplification. Yes, it's on sale of shares. It's also on sale of classic cars, possibly on houses. You've got to say, if they up the 20% to 30% or 40%, the 0% cannot survive because the gap is just too big. It's illogical. So you've got to bet on a change coming. Now, we've also had another question in: can this be more than 2 or 3 shareholders? And the answer to that is yes, so long as all the shareholders are selling more than 51%. The key with employee ownership trust is change of control needs to occur. Okay, so just some points on implementation before we move on to a sort of live example on structure, and that is that we talked about the flexibility of them over a period of say 3 to 7 years. You can lock in that 0% against your future cash flow. The objection given is, well, my team isn't ready, but you've got time to get your team ready. And one of the key ways that we're doing it, and it's unique to us as advisors, we have a strategy practice. We also have board mentoring groups. So by pulling in key managers within that arena, either on business planning and or board mentoring, you can support the management team to make the transition, and you can plan the cultural change. Certainly, I'll be talking to Sue later as a key member of the Employee Ownership Association, and she's shared with me that the number of companies, a number of employees wandering around the association going, well, we think it's a tax construct because nothing's changed. And that's a real missed opportunity. So we're really keen to embed change in culture and strategy alongside the transition of employee ownership trust. So yes, the deal's done on day one, but you've got time to then build the team behind the scenes. One of our employee ownership clients is recruiting a managing director, for example, as we speak. So the real ability to build flexibility into the structure. Let's just turn it into a real quick set of numbers. This works if you've got 7+ employees, and therefore, typically 2 to 30 million value. And looking at vendor loan note here, I've given an example of a chunk of 1 million, but if the value were 1 million, you can see a vendor loan note there being paid. Bear in mind there's salary sacrifice coming in from the shareholder directors on day one, which is boosting cash flow. But you need to allow for corporation tax, you need to allow for capex. So an EBITDA model's fine, adjusting for COVID lockdown, but also you do need to allow for capital expenditure, and then there needs to be some headroom in that cash flow behind your analysis of any vendor loan or third-party debt. But you can see here on this example, £1 million vendor loan over 7 years, and the repayment there being 160,000 a year. So a really good way of getting money out, and that's at a 5% interest. And that obviously is subject to getting HMRC clearance, but HMRC are not going to challenge your cash flow. They may challenge the multiple you've used, but as you know, multiples are highly subjective in the emerging mid-market sector. I mean, we genuinely have one project at the moment, trade interest, but multiples are ranging between 5 and 8. So, HMRC are looking much more at did control change than they are specifically, is that multiple correct in terms of value? So you can, to a certain extent, value these things on the other way around as, well, what is the cash flow affordability? Can we afford to make the repayments? And therefore, what value might we then attribute to the business? So you can see there, though, £1 million over 7 years, 169,000 a year. So highly affordable despite the 5% yield. Okay, so trade versus employee ownership trust. EOTs leave a legacy. One other benefit, less warranties, like due diligence. COVID, we're still seeing trade buyers, they're highly active, organic growth is slow, there's limited yield opportunity, so they are very interested in acquisitions. However, shareholder governance means that they have to be risk adverse, so due diligence just got heavier to allow for that cash flow volatility. Employee ownership trust, in a way, you're both buyer and seller, so much softer due diligence arena, and you can build your COVID lockdown model. You don't have to argue with a third party to agree it. Also, much more confidential. Trade sales have confidentiality issues. We do our best, but we can't guarantee it. Further, it's also much better in terms of the legacy of the business without, there is a cultural shift to employee driven, but it's not as dramatic as when a business is bought into a trade company, absorbed, and all the changes that encompass there for your management. So really interesting balance between the two, and that tax between 0 and 20%, 0 and 40%, who knows, is really changing that balance to make them much more attractive. And soft due diligence, a major plus. So I'm not going to go through each one of these steps because I'm anxious to get Sue Lawrence, our expert, in and joining me in a second, and also answer a few more of the questions. But we see the structuring as two elements. One, the financial model. So what's the cash flow? What's the headroom? Less capex, less corporation tax. After adjusting for reducing shareholders' salary, how much can we afford to pay over what duration? Then come back at values. Does that therefore impact on a comparative multiple basis in a way that we think HMRC will get clearance? We do all that financial modelling, we get third-party debt, and we go and get clearance. But the other side of the transaction is also the trust, the legal elements, the change to the articles, the directorship structure, establishing a bonus structure for the team, consulting with the team, pushing through the cultural changes with the team. So you've got all the structure inside of it. So there's two projects effectively being run in parallel there to create the one end result, data completion, handover to the trust. Typically, we're running employee ownership with the due diligence within a 2 to 3 month period. Now, if you've got no third-party debt, you can do it in 2 months. If you've got third-party debt, it's typically 3 months whilst they do their due diligence on the business. On that note, we have had a question, does a civil loan with its payout restrictions block an EOT? And the answer is yes. On some of the loan agreements that we've seen, it does, but there's been some where we've seen it hasn't. So we've got to look at it on a case-by-case basis. So, but if you work on the basis it does, and then we can then examine whether there's a way of using it as a plus point. Okay, so determining factors, tax, succession. Have you got a team that could run it, or can you build that team that could run it? What's your cash flow? How much can you afford over what duration? What's a reasonable duration? Timing. Is there a window of opportunity right now before next April at 0% tax, which may not exist after that? Soft vendor due diligence, no third party trawling all over your business, pulling it apart, arguing about post-COVID cash flow volatility. Sector, again, there are some sectors that just are not going to be easy post-COVID. Strategy, can we align the business model, the business plan, and a team-driven environment with the business strategy? That is critical. Too many of these have been done where it's just a tax construct and they haven't got the strategy right, nor the handover and support to the team. Obviously, age of sellers, when is it right for me to exit the business? I've got to say, you guys, with that 0% tax, at 50, I looked at it myself. At 55, I'd be doing it. At 50, not yet. But, it's subjective, depends on your age. Can we get HMRC clearance? And actually, what's happening within the market? Clearly, if your business is highly attractive from a trade point of view, and we can get into those upper multiple ranges of 7 to 10, then the trade deal may still be more compelling. But if it's not, then EOTs are a really attractive alternative. And the big barrier to entry that's been looked at previously is, well, I need all my cash out of day one. Let's throw that open to challenge, because do you? The world has changed post-COVID, and our outlook has changed, and therefore, do we really need that money? Or is it more about making sure we've locked the value in at 0%, rewarded our staff, and also created a more productive business in the future as a legacy? So, sorry to rabbit, as I say, I've had 2 coffees this morning, so I'm really in flow. So I'm going to bring Sue in. Sue, if you could turn the camera on and join in. How are you this morning?
I'm fine, thanks. Haven't had as many coffees as you. So.
Yeah. I don't know what was in the first one, but that's stale. But good. How did I do, and what struck you about? That
was good. I was going to add a couple of comments actually, and maybe answer some of those questions. One thing I would pick up on one of the early slides about succession planning as well. I don't think it should be underestimated that if you're thinking about moving your business, your employees are fully aware of you're thinking about it. They're getting nervous, they're getting worried. So actually being able to communicate that the business will stay as it is actually quite a powerful message, and actually might calm down nerves across the employee sort of position in your company. So just another added benefit of being able to be open to people. We also touched on sort of HMRC as well. Sorry, Kevin.
Before we finish that point, I mentioned this is a really good option as opposed to an MBO. Why do you think I mentioned that? What's your view on that?
Yeah, I just think management buyout, one, the managers have to fund it. But I think the benefit of an EO is that all the employees own the business. So you get the engagement of all the employees. You're going from sort of a small group of people owning the business, building up that ethos and the culture of the business. That doesn't change. If it goes into the employees, it can be enhanced because it's the employees that create that culture and they're growing it. If you move it on to an MBO, yes, the managers have to then fund it, which is not always easy, particularly at this time. But also it maybe doesn't get the benefit of grabbing the engagement of all the employees.
But you know, as you're saying, the key managers though, aren't they going to be disappointed? I mean, surely if I do a management buyout, I can own it and I can build it and then get the shareholder value in the future, can't I? I mean,
yeah. And you remember we've talked to a few people around sort of putting in place EMIs at the same time alongside it, so that those significant managers still get that uplift benefit as well. So they're tied to the business because they're important, but also they're getting more out of it because of their contribution.
I think that's right. I think, you know, they probably will move more towards taking bonus and pension contributions. So it's more like a PLC almost in the way that it's set up. And this whole distortion of shareholder value. Oh, well, we've got to build it up and sell it in 10 years. And then we've got to sell it in 10 years. And, you know, that all goes. So you actually build, and I think it's purposeful capitalism, you build a more sustainable life cycle in terms of that business. So it can take longer investment decisions as well, can't it? So, yeah. As a capitalist, this is really good because it's more like almost creating a family around the employees. So you create a longer vision for the business, which is exciting.
Yeah, there was a question in the Q&A as well about somebody asked if you transferred 51%, how could you sell the 49% in the future and could you sell it externally? I think I sit as an independent trustee on a couple of EOTs, and our conversations with the operating board is always around if there's an opportunity to sell the business, the 49% in the future, the first option should really go to the trustees. So you should be looking to sort of sell it to the trustees first. But actually the best option might be to sell it to somebody externally, so you're bringing in sort of fresh views. There's another add-on question as well, is could you ever sell the EOT itself? And I've bounced this around with a few clients and a few other people in the industry. And I think the answer is we've not really seen one, but there's no reason to stop it. But it would have to be in the best interest of the employees, because let's remember the trust is in place to protect the employees as the shareholders, not as the employees, but as the shareholders. And if the best option is to sell the company, maybe merge with another EO company would be the ideal. But if the best benefit is to sell the company because it will still exist rather than maybe it going into default, then there's nothing to stop it. But we haven't seen it in the market yet.
Yeah, but I suppose that's a bit like, you remember when all these building societies were mutuals? Again, it's got this, EOs have got a bit of a similar flavour, haven't they? And it did become commercially viable because for a while their multiples were off the scale in terms of you know, their floats or commercialisation. So we were all getting our little payouts, weren't we, when that happened? But it's a bit similar. It's got to be at high multiples to drive it, hasn't it? Otherwise, why do it?
Yeah. Yeah, I do think my personal view as well is obviously there has to be cleared by HMRC, and I think there was a question around sort of does the vendor loan have to have interest on it. I think part of that is it's got to be a commercial loan. When you've got the vendor loan sitting in the business, it should be seen as third-party debt almost, rather than a loan to people who used to own the business. I think it's important that it has an interest rate to it. You mentioned 5%. It's not always 5%. It's what's relevant at the time. But also, I think going forward, I would expect HMRC to come in and challenge some of these in the future, because I do know of at least one. I met some people at the EO Association conference last year, and they didn't believe that their vendor had actually sold the company. They had, in theory, sold the company, taken the capital gains benefit, but they were still running it as if they owned the company with absolutely no change. So I do think HMRC at some point might go in and just validate some in the future. So it's got to be hearts and minds transfer justify it as well, I think.
Which is why, whilst we've got, so I do the finance and my team do the finance, you do the, had that slide on implementation, you do that bit.
Yeah.
The third bit that we both work on is business plan, transition, handover, change of control, change of culture. Yeah, this is a huge opportunity to create team-driven businesses. But if the conversation stays the same on day 2, there's no point.
Yeah.
You just got a tax construct, and that, do you know what? Kind of nice to get your value that way, but yeah, it might get queried, and also you've just missed a trick, haven't you? You've got a real opportunity here to
especially as well. I think if it's the business that you've grown, you'll put your whole heart and soul into this business. You want to make sure that it continues. It's your legacy going forwards. I think that's quite important.
So we've had the question. Someone missed the 0% point. I said it's under review. We talked about it yesterday. Your opinion, will it change?
I think it will. I don't think it will be as high as the others, but I think it will at some point. But I'm not a tax person. I'm not a finance person. But sort of, if I was a chance of sitting there and I'm trying to find some money to pay for things, yeah, I'd probably take it.
I'd leave them where they are and I'd go after private homes. But because there's far more money on that. There's only, I think the stats are something like 250,000 got entrepreneurs relief. It's a very small revenue.
That's the joy of tax. We never know which way it's going to go. So whatever you think it's going to happen, it'll probably do the opposite.
Always surprising. Good point. Okay, so yes, you were going to make some other points on.
Right. How long does it take? Somebody asked that. I know you answered that question, 2 to 3 months. I'm actually working with somebody who notified their staff 2 years ago this was going to happen. It's now delayed, but actually what they've done with theirs is engage their staff all the way through. So it's been they've done staff engagement. But we've worked on one that they told the staff on the day it was implemented. So it's different depending on which the company is. Smaller companies probably quicker because actually the communications is quick. But yeah, 2 to 3 months really is the shortest time. And the thing that really is the driver, the one thing that you can't control is the HMRC clearance. It goes in, normally we get it back quite quickly, but there's no guarantee.
Yeah, okay. And we've had the question, if a seller is offshore, will they benefit from the 0% tax? I don't know the answer to that. So we'll have to come back to that one. So we'll check that. I think probably not was the answer. Also, if it's a divisional sale, then you benefit from 0% as a sale of a subsidiary, but you're not going to get the 0% if it's a subsidiary sale. So we'll check into that. Okay, so now, from a point of view, we had a good question here. Are there any major differences between an EOT and a general social enterprise, such as a mutual society?
Ooh. So I suppose a mutual society is normally owned by its members, isn't it? And it's owned directly. The EOT, in that structure, the trust owns the shares of the company on behalf of the employees. So the employees don't hold it directly. They hold, the trust holds the shares on benefit for the employees. If an employee leaves the company, they lose the benefit of that trust. So they're only a member of the EOT whilst they're an employee of the company. Whereas a mutual, I think it's more around being a membership and owning a part of it. It's a bit like a membership association, I suppose. So yeah, it's slightly different. The EOT is more, it continues to be a company, it continues to have an operating board that runs the day-to-day business of the company.
And actually, I mean, we've had a question, which has been the biggest. Well, recently it's Aardman Communications, Wallace and Gromit, and Richard Sounds, isn't it? They've been the 2 large ones that have gone. Julian kept 40%. Do you know why you did that, Sue? Because I'm of a view go for the 100%, not the 0% in. But why did you follow that one? Do you know why you did that?
Yeah, I know they presented at the association conference last year, and I know that question was asked, and I still can't remember the answer. I think it was to protect the ethos of the business and because they wanted to keep involved, but it wasn't an intention to sort of sell on to anybody. One of the reasons Aardman kept it was to stop it going into Hollywood and being lost in Disney or somewhere. That they wanted to keep it now independent.
I've been sneaky in terms of that 40%. I think I know because I read the press release, and they're not
got a better memory than me.
They're not going to tell you why, but it's inheritance tax.
Yeah.
if you've got shares in a limited company, they pass on inheritance tax. Private limited company pass on free of inheritance tax. If you've realised it into cash and then you die, you pay 40%. So why bother doing that? So they've held them for the benefit of the family in the future. But of course, you can't say that in a press release, can you? So
could you start recording that bit? Yeah.
That's my bet. Okay, fine. I mentioned earlier, Sue, I think a big barrier to, I'm surprised more people don't explore this, okay? And I think, people just perceive it as complicated. They perceive it as a tax scheme. What's your view on that?
I think it's knowledge and awareness. I think it's been quite obvious that when one or two companies in a particular sector transfer, suddenly there's a whole wave of people coming behind it. I think the big example is the architects companies. One or two have done it and now they're all doing it. It's all flown through. And we've seen sort of new people in new sectors where when the first company does it, there's a lot of press around it, and then suddenly everybody else is looking at it. So I think a lot of it's just awareness and realizing potentially how easy it is to do. Because it's not a difficult process. The legals are quite easy. The clearance is relatively straightforward. I think the key one is making sure you've got the financials right. And actually, I mean, we should touch on that. Sort of, we spoke to somebody earlier in the week around is it a definitive number at the outset? Well, actually, that financial modelling that you and your team do is really important because it can bring in the nuances of the particular company and make a difference to whether you take 20% up front, 30% up front, 60, 70, 80% going through on the vendor loan. And all of those sort of bringing in the cost of management team going forward and modelling all that is quite important at the outset. And it's also the thing that the trustees monitor as they look at the health of the company for the first few years until the vendor loan's paid off.
I think the other barrier has been that perception. I'm not going to get as much up front. It's structured over too long a period. I want my cash so I can, head off to Spain or Portugal or whatever. But that's changed. So I genuinely think that has been a hurdle where people have gone, well, and also, the trade sale, everybody feels that should be what they get. I must be able to get that multiple of 7 and it will be a international buyer and all the rest of it. Well, practically sometimes that's not as easy. So ego says get your high multiple, trade deal, walk away, go down the golf club, because that's the story we're all sold, isn't it? You haven't met anyone down the golf club that's done an EOT. But actually, if we reflect and put ego aside, this is, well, actually, why not carry on working? Why not stay involved? Why not do that value play, but actually continue to see the legacy grow as an independent business?
And actually, that's what we're seeing where there's been multiple owners as well, is that maybe one of the owners wants to leave and the others, maybe one or two, want to stay in the business. And this is a good way of sort of coping with that split expectation of where they want to take the business. The one who wants to leave can go, the other ones can stay. So it means that not all of the shareholders selling those shares have to have the same route.
What have we've been around the Employee Ownership Association. What have you seen, apart from the possibility of HMRC looking at it? Where else do you think people go wrong with this planning? What's the sort of biggest downfall for you, Sue?
Yeah, I think sometimes it's the communication. Sometimes it's this expectation that it will change straight away, and it doesn't change straight away. It's a transition into it, and it does take a while to transition. I think sometimes there's an expectation on day 2, suddenly the productivity is going to go up and everything's going to be rosy and everybody's going to be committed. It takes a while for people to understand that there's been a change. Yeah. But while that's happening, people still remain doing the same job. It doesn't affect anybody's day job. I think that's the message going across. So I think that there's a lot of numbers shared out there about productivity going up, engaged employees, etc., etc. I think that takes time to build. It doesn't happen on day 1. And some companies already have that already. So it's not going to make a big change to a company that's already very productive or has engaged staff.
And what about tensions between trustee and management? I mean, remember, as an owner, you've sold out. You may still sit in management in some place. Any clashes?
I never clash with anyone, Kevin. What are you talking about? I think it is important, though, that it's very clear that there's a differentiation of the roles. I was on a meeting earlier in the week or last week with the board and the trustees, and we were talking about sort of employee engagement. And at one point they wanted to have the employee voice, or whatever it's called, the social part of the employees, reporting into the trustees. And I'm like, no, hold on a second. The trustees are looking after the employees as owners, not as employees. You as the operating board are looking after the employees as employees. And it's that circle of ownership. There's a board that looks after the operations of the business. The employees still do their job, and the trustees are just the shareholders. That the trust and the board interaction, they both want the same thing. They both want the company to be successful. I think sometimes boards are wary that a trust's going to come in and tell them what to do. Well, that's not the trust job. There is one of under the trustee, it's normally a responsibility of the trustees to ensure that the board are doing a good job and have oversight of the board. And my personal view, and the way I work with my team, because there's a group of us who work as trustees, is to say, well, actually, it's not you as an individual. It's actually, is a board effective in delivering against the purpose of the company? And actually focusing on the purpose of the company, and is the board doing a good job of that, rather than the individuals on the board? And you take the personal away from it. And I think that's when somebody's been running their own business with nobody to account to, that's quite a difficult sort of change to have put in place. But it is to focus on the purpose of the company rather than that Excel or how good is your FD. That's not a question for the trustees.
So the management, which is, so it's really fascinating, Sue, because I love talking to you, because you know you're how to put this nicely, a board governance geek, and we've both been quite involved with institute directors over the years, and I've mentioned this to them, and we need to have another conversation with them, but they haven't really sort of picked up on this again. You know, is that just again your point about lack of press or just lack of awareness? What, you know, it is a great solution for businesses, yet you know people don't pick up on it. Why haven't the IOD gone down the route?
Yeah, it's interesting. I talk to IOD and other associations in that governance space and talk about it, and it's also yeah, I get that, but it's almost like that they feel like it's just it's too small, or it's not relevant to them, or there will no longer. It has a feel that there are no longer directors in the company, but actually there's still an operating board. It's still important. So I think raising that profile of the governance of it and how it works, and actually the trustees are directors just of the trust board. You've still got directors of the business, and they still have to act in those 7 principles of being a good director still have to apply to those directors. Which actually,
you know, so I think people selling it have been selling it too much on the tax and not enough on the strategy again. You know, that's a key message. If you think about it, you know, there's 300,000 commercial SMEs in the UK. There's only 370,000 of these. There is room for 10,000 DOT pluses in the UK. It's a great structure. It's easy to get at. Yes, financial modelling. Yes, the right implementation. So yeah, we've had the question here. Can EOTs have multiple classes of shares? Do they have different share values?
No, the trust only has 1 class of shares, and the distributions amongst the staff have to be equal. There are 3 elements that you can distribute to the staff, but they're based on longevity in the business, salary, and working time, so part-time, full-time, or whatever. You can't base it on seniority, because it's supposed to be equal to also, and it's got to be very open, but you can change it every year. So you don't have to follow the same route when you distribute those dividends to the staff. But no, it's only 1 class of shares.
Okay, so when I mentioned, you know, the vendor loan argument is that it can be kicked out or even waived. With the COVID backdrop, very depressing all that, but you know, have you seen any waived in your trusteeship of you know? Have you had to go and talk to ex-shareholders at all?
Interestingly, the shareholders tend to come to the trustees and say, we'd like to waive our payments for a while, because they recognise how important it is for the business to be successful for everybody. So yeah, we waived some payments, deferred some payments, move things forward. I'm hoping that at some point we'll get to the stage where we bring them back forward again. So because the vendor loan is being approved by the trustees, you've got that flexibility of paying more upfront or deferring it.
Now we just want to go. I want to go full circle for a second, Sue. I want to go back to the benefit for management, just for a second, rather than an MBO. So, it's not as good as an MBO if you can buy the shares, hold them direct, and then sell it out for double the value or triple the value in 5 years. Correct? But you can make your money through pension bonus and also the tax efficiency. You get your tax-free lump sum. What happens if I'm a great general manager? I am growing the business by twofold every 5 years. Great MD. I want a Bentley. Now, as an owner, manager, director, I probably could have got it. Here, what's the trustees' view of me saying, no, I need a Bentley. I need to do the capitalist thing. I've justified it in the interest of the employees.
There's nothing stopping the operating board changing salaries and giving bonuses outside of the trust. Yeah. So you're probably still in the same place. Yes, you didn't buy the company. You didn't have to pay any money out to buy the company, but you can still be valued in the company financially by doing a good job. Particularly if you're a salesperson, that's easy, commissions, whatever. You don't lose the commission structure, and you can tailor it.
So packages can end up in the upper quartile for the sector, and certainly higher than owner-driven businesses, because owner-driven businesses, they're taking out their higher profits, aren't they? Dividend, so that tends to reduce salaries in SMEs compared to, say, corporates.
Yeah.
So you can get closer to corporate pay, yet still have the SME benefit. I think probably the Bentley's too much, but I think the Tesla, because it's 100% corporation tax deductible in the first year, more tax effective, more in line with the benefits to the employees. But
now, I'd be buying another caterer, that.
Okay, all right. So we'll go with that. Okay. Well, with the Employee Ownership Association, what benefit do I get from being a member there, and are they underutilised?
I think once you remember that they're a really good network of people you can share ideas with and ask questions of, and just ask those sort of, we're thinking of doing this, what have you done? Or it's a combination of people who are thinking about becoming employee owned, people who are already employee owned, people who are transitioning, and some of the suppliers and providers as well. So I think it's quite a good forum to share things. Who knows what's going to happen with the conference this year, whether it will go online. It's normally in October, November time, so we'll wait and see on that. So the one thing I would say about the sector as well is there's this presumption that it's all John Lewis. You often have people saying, oh, that's like John Lewis. Some of my answers to some people is like, well, it's probably more a bit like Waitrose than John Lewis. And John Lewis has been in this structure since it was formed, however many, over a century ago. I think the majority of employee-owned businesses are not like John Lewis. They're actually totally different, and these changes came in place 2014, and that's when it really took off. So yeah, there's a lot of people sort of have got that experience of working in that employee-owned business. A lot of people in the sector have come out of John Lewis, probably more coming forward. Sort of one of our independent trustees that I work with is an ex-John Lewis guy, so he's got sort of both sides of the fence. You can see sort of the governance structure in John Lewis is multitudinous layers. It's very complex, whereas most EOs are quite simple. They have a trust, they have a board, they might have an employee representative forum, and that's it. They don't have other layers. But so I think when anybody says to me, oh, that's like John Lewis, I try and persuade them it's not really. It's just slightly different.
And with your trustee work, so the big point that's always sold is employees feel that they are owners more. They feel more involved. Does that come across when you walk shop floor?
Yeah, I think after a while it does. I think it takes a while for people to understand what it means and what it looks like. But I think there's certainly a lot. It maintains probably, as I said before, the ethos of the business, family. Particularly if it's been a family-owned business, it still feels like a family. It's just that the family's got bigger.
Okay, Sue. Well, anything else you want to add, or shall we say that we've done our 50 minutes and remind people that we will be sending the slides out. We will do a sort of Q&A follow-up. So we'll try and sort of type out specific answers and circulate that to everyone that's joined in. Please, if you thought it's interesting, share the webinar. It will go on the front page of our website. So and there are a number of other webinars on EOTs, EBITDA analysis, mergers and acquisitions post-COVID, all sorts of bits and bobs. We've got a few more webinars coming up. The scale-up boards is interesting. That is around how you can strategically support, board governance and strategy through peer-to-peer learning. We've also got a big one coming up on tax, again, picking up on those potential changes. So as our expert on EOT, I'll leave you with a final summing up. And you want to sort of, make a final point on?
If you're thinking of selling your business, why would you think of anything else? It's a win-win for every side.
Okay, brilliant. Well, good line. I certainly think it should be on the shopping list. And we're very happy if you've got any clients or you're considering doing this yourself, both Sue and I are available. Look at our details online, and they're in this slide pack as well, the emails, etc. So, please pick the phone up. We're happy to chew the fat and examine your options. So thank you all for listening, and have a great day. Cheers.
Bye, everyone.
Bye. Bye.